Alright, so in today's video, we're taking a closer look at the MACD indicator, what it is, how it works, and how you can actually use it in your trading. It's a pretty simple tool, but when you understand it right, it can really take your trading to the next level. Of course, there are a few little details you'll want to watch out for, just to avoid making those classic beginner mistakes. Well, enough talk, let's get straight into it. The MACD, or the Moving Average Convergence Divergence, is one of the most popular technical indicators used by traders. Essentially, this indicator uses moving averages to find trends in the market, and it's pretty damn good at it too. Now, if you're an experienced trader, you've probably used or heard about this MACD indicator before. But the MACD indicator by itself is just alright, to be honest. So make sure you watch this full video to see how to pair it with some other indicators to make it perform so much better. First things first, let's add the MACD indicator to our chart. To do that, you're going to go to Margex, and then you're going to go up here to the Indicators tab, type in MACD, and click this top one. Now that we have the MACD indicator added, let's make sure we know how the MACD actually works. MACD stands for Moving Average Convergence Divergence. Gerald Apple developed it in the late 1970s as a tool that utilizes moving averages to determine the momentum of an asset. Before diving into the mechanisms of MACD, it is essential to understand the concept of moving averages. A moving average is simply a line that represents the average value of previous data during a predefined period and can be divided into two different types: simple moving averages, also known as an SMA, and exponential moving averages, also known as an EMA. While the SMA assigns equal weight to all previous data, an EMA assigns more importance to the most recent data values. The MACD indicator is calculated by subtracting two exponential moving averages to create the main MACD line. This line is then used to calculate another EMA that is referred to as the signal line. In addition to the MACD and signal lines, the MACD chart also has a histogram, which is generated based on the differences between those two lines. The MACD indicator consists of three elements moving above and below the center line: the MACD line, the signal line, and the histogram. The MACD line helps determine upward or downward momentum by measuring the gap between two exponential moving averages. The signal line is usually a 9-period EMA of the MACD line. That is a 9-day EMA on daily charts, a 9-hour EMA on hourly charts, and so forth. The MACD histogram is a graphical representation that is calculated based on the differences between the other two lines. But instead of adding a third moving line, the histogram is made of a bar graph, making it visually easier to read and interpret. As the name suggests, the Moving Average Convergence Divergence indicator tracks the relationships between moving averages, and the correlation between the two lines can be described as either convergent or divergent. Convergent when the lines gravitate toward one another, and divergent when they move apart. The relevant signals of the MACD indicator are related to the so-called crossovers, which happen when the MACD line crosses above or below the center line, or above or below the signal line. Keep in mind that both center line and signal line crossovers may happen multiple times, producing many false and tricky signals, especially in regards to volatile assets, such as cryptocurrencies. Therefore, one should not rely on the MACD indicator alone. Traders consider the MACD indicator a useful tool for identifying market trends and momentum. So, as you can see just by watching this indicator is extremely easy to use. But the problem most traders encounter is that they only use this indicator by itself. Let me tell you why this doesn't work. The MACD indicator works extremely well if the market is in a trend. So for example here, the MACD indicator is doing a great job indicating when the price is about to move upward because the chart is in an upward trend. But here the price is in a downward trend, but the MACD is still signaling to buy long even though the price is going down. A simple fix to this issue: for example, if we're trading long, we only want to trade if the market is in an uptrend. You never want to trade against the trend because the odds will always be against you. So an easy way to figure out if the market is in an uptrend, you simply just need to add a 200-day moving average. To do this, you're going to go to the Indicators tab on Margex and type in EMA, which stands for Exponential Moving Average or Moving Average Exponential. Click the top one, then you're gonna go here, click the settings of the EMA, and you're gonna go to inputs and change the length to 200, which is gonna make it a 200 exponential moving average. Then you're gonna go to style, and I like to make mine red, but you can make it whatever color you want. Once we have the EMA indicator added, you'll see just a single line. If the price is above that line, the market is in an uptrend. If the price is below that line, the market is in a downtrend. So after learning that we only only want to trade in an uptrend market if we're going long. All we have to do is put it all together. We buy if the MACD line crosses below the 0 line mark and the current price also is above the 200-day moving average. This will guarantee that you are only trading when the market is in an uptrend, which is a very powerful combo. If you wanted to short, you would do the exact opposite, so make sure the price is below the 200-day moving average and the MACD lines are crossing downward above the 0 line. So as an example, we would want to enter a long trade right here because the MACD lines are crossing upwards below the 0 line and the current price is above the 200-day moving average. Now, what I like to do is set a stop loss below the 200-day moving average. So the 200-day almost acts as a wall that the price has to break through to hit the stop loss. Then I like to have a 1.5% profit ratio for my profit target mark. So as you can see for this example, the strategy worked exactly as we wanted it to and we made profit. But we can still make this trading strategy even better. This MACD strategy combined with a 200-day moving average works extremely well only if there's a lot of price movement. Where the strategy starts to get kind of iffy and giving false signals is when the chart starts going sideways and losing momentum. So as you can see here, the chart is moving sideways and lost almost all of its upward momentum, and the MACD is giving lots of false signals. If you traded here, odds are you probably lost money. To fix this issue, we have to combine the MACD with price action. To do this, identify a key support or resistance where the price hits and bounces. So as you can see, the price goes down, hits this point, and reverses upwards. The next step is to wait for that price to hit the same key level again, and once it does, we are expecting the price to bounce off this support and go upwards just like it did before. But as a clear side note, just because we made this support and it bounced off this before doesn't mean that it will always do it again. It can easily break through the support and drop lower if it has enough momentum. If we want to make sure the price is about to change in momentum, that's when we bring out the MACD indicator. So what you would do is make sure the price is above the 200-day moving average. Once the price hits the support made, wait for the lines on the MACD to cross below the 0 level, and that's when you enter the trade. I just revealed to you how the MACD 200-day moving average and using support and resistance levels gives new trading opportunities. All I ask in return is if you can take 2 seconds of your time and like this video. If you want to stay up to date with our future strategies, make sure to subscribe. Hope you all learned something from this video, and I'll see you guys next time.